Good morning. Welcome to Trading Hour. It's a brand new week. I'm Reema Tendulkar. With me are Surbhi Upadhyay and Pavitra Parekh. Girls, who thought like today was the day we were going to break out? In the morning, tell me, did you think that markets would be doing a lot better than a 12-point up move?
I don't want to say this, but I had a feeling.
That you would do better? We would do better?
No, the fact that this is going to be a bit of a no reaction, because in Reliance, absolutely fantastic numbers. What's new? What's new that can materially move a stock as large as RIL? Yeah. And for ICICI Bank, this is what we're discussing even ahead of time, right? That margins are peaking is the best in the price. And then the market's mood, I think, is just... it's a, what should I say? Nonchalance, no show.
No show. We're wedged in such a tight band. Okay, did you think we would do better than what we're doing right now?
Definitely better than 12 points, right? We were all talking about that. And maybe
even the SGX Nifty was more excited.
The SGX was more excited. We were talking about how all of last week was so dull, and Wipro is moving well. IT is holding up. What more do you do to make the market move?
Well, today, unfortunately, Asia is a bit on the back foot. So Kospi is down close to about 1%. Hang Seng is down about 0.6%. But if you pull up the contribution plate, you would see that there is no one big drag on the markets. On the way up, yes, you've got a positive momentum coming in from ICICI and Reliance post the numbers. But on the way down, unlike last week, which is all about IT and that big drag coming in from IT, look at the contribution plate. You've got minor downtakes in many stocks across sectors. Kotak Mahindra Bank and L&T, ITC, Sun Pharma, across across individual sectors, you've got some stocks. But all in all, markets continue to remain wedged in a very, very tight band. Right now, markets opened up well. They had a slip. And the current levels on the Nifty and the Sensex are just a fractional of a gain. Up 10 points on the Nifty, Sensex up 40 points. That said, we've got a lot of cues lined up through the course of this week. It's going to be an action-packed, busy week today. Numbers from Indices Bank and Century Textiles. But later this week, you've got Axis Bank, Kotak Mahindra Bank, Bajaj Finance, FinServ, HDFC Asset Management in the FMCG pack, Tata Consumer, Nestle, HUL. IT names like Tech Mahindra, Wipro, Ultratech Cement, Maruti Suzuki. I'm listing out all the companies that are going to be declaring numbers in this week itself. So it's going to be an action-packed week. Plus, you've got the primary market hot, Mankind Pharma IPO. It's a large company hitting, for subscription from tomorrow onwards. And plus, you've got the expiry as well. Mid-caps were holding up pretty okay, up, at least for the last couple of days. But today, the performance is absolutely flat. But in the month of April, mid-caps have outperformed the benchmark indices.
Okay, well, that's the local picture. If it, makes us feel any better, I think globally as well, there's no real trigger that is leading to a big directional move. It's kind of one day up, one day down, right? Asia, as Reema pointed out, markets are down. The Hong Kong market, by the way, is down about 1%. Some of the regional markets like Singapore are closed for holidays. But largely speaking, it's tracking cues, tracking earnings, even in the global landscape. I was looking at some of the numbers that FactSet puts out in terms of earnings season in the US. Now, the companies that have reported on the S&P 500, 78% are above estimates, so 76% rather. But the market isn't too enthused. Why is that? Because anyway, estimates are saying that there will be an overall 5.2, 5.3% sort of a decline in S&P 500 earnings. So while, yes, you're beating estimates, there's no taking away from the fact that corporate profitability has fallen as the calendar year kicks off. And maybe that's kind of weighing on sentiment. There's a lot lined up, by the way, a lot of tech earnings this week. You've got Meta, Amazon, Alphabet, Microsoft. Today, in terms of global earnings, there's Coca-Cola. Some of these troubled banks, Credit Suisse, for what it's worth, will report. First Republic Bank will report today. So there's a lot lined up in terms of the earnings calendar. But the market's been extremely range-bound. There's macro data as well. There is Q1 GDP, there's consumer sentiment, and of course the guessing game continues into whether it's a 25 basis points rate hike from the Fed in May or not. That is the consensus right now. Look at the bond markets. I mean, you're not getting any cues there. That US 10-year has been so range-bound around the 3.5% kind of pivot. Dollar between 101 to 102, locked in a range. Crude also, I mean, it does give you these wild moves in terms of price action, 3-4% one day up or down, but largely crude hasn't done too much. It's still hovering in about a $5 kind of a band around the 80 mark. So guys, well, it's not just our markets, it's asset classes around the world, it's equities pretty much around the world that just don't know where to. There used to be a saying, sell in May and go away. I don't know, Pavitra. That's what people are already, they're preponing that to April.
You said if it makes you feel better, it makes us feel a lot better, that this is happening everywhere else as well. We don't have to sit and watch the screen like this just by ourselves. But, since we were talking about the markets being dull, the small cap index is holding up well today. So that's up more than 0.5% right now. The advanced decline also positive, just mildly positive, but it is positive right now. I'm going to just point out a few of the spaces where we are seeing good moves come through because we've gone through enough of the flat action. You have some of the tech names which are doing well. Take a look at Scient, it's up 3% right now. You have something like a Persistent, LTI, Mindtree, which are holding up better. Some of the banks, the smaller banks that is, so take a look at Punjab and Sindh Bank, your Bank of Maharashtra, these ones seeing good gains. And take a look at all of the railway linked stocks once again after the kind of move that we saw earlier in this month. These are the kind of gains that you're seeing. RVNL is up almost 10%, you have Realty seeing a 5% move, Ircon as well up almost 10%. So that's what's going on with the stocks. We will keep coming back to this, but first up, let's bring you our top story today. The Reserve Bank has offered HDFC Bank relief on priority sector lending norms and has permitted the merged HDFC entity to now hike stake in HDFC Ergo as well as in HDFC Life to over 50%. This is before the effective date of the merger. So what does this actually mean and what are the brokerages saying on this? We have Abhishek here with a complete roundup. Abhishek.
Well, Pavitra, as you mentioned, RBI has provided certain clarification for requests made by HDFC Bank and HDFC Limited with respect to merger of both the entities. So first up, for priority sector lending target, 1/3 of HDFC's outstanding loans will be taken care of priority sector lending target for first year. The balance 2/3 will be done over the next 2 years. So this is a big relief in terms of meeting the priority sector lending norms. Investments including arms and associates of HDFC Limited can continue as investments for HDFC Bank. So with respect to stake in HDFC Life and HDFC Ergo, the bank can take up stake over 50% in both the entities. For HDFC Credila, they have to take the stake to 10%, down to 10% within 2 years. Other highlights are that they have to comply with CRR, that is cash reserve ratio requirement, SLR statutory liquidity ratio requirement, and LCR, that is liquidity coverage ratio without any exception. So from day one, they will have to meet the CRR, SLR and the LCR requirement of the merged entity. So HDFC's rates to be linked to benchmark within 6 months. This is a positive news given the fact that this will help in the yields remaining on the healthier side. HDFC Bank has arranged a con call in which they say the requirement for PSL kicks in only 12 months after effective date. So they have some time in terms of meeting the requisites, carrying excess LCR already in the balance sheet, and they are also carrying excess SLR as well as the CRR above the requisite norms. So brokerages have written note. CLSA says that a glide path of 2 to 3 years provides adequate time for HDFC Bank to reduce its priority sector lending norms versus negative PSL impact that would have happened on day one of the merger. Bernstein has also written, they say that the development increases the confidence of a smooth merger process for HDFC Bank and HDFC Limited. The pros and cons of RBI announcement: priority sector lending requisite meeting time is sufficient for the lenders to meet that norm. However, meeting CRR SLR requirement from day one can have slight impact on the immediate earning profile of the merged entity. However, it will get played out over the next couple of quarters. So things which are still pending with RBI in terms of the application and permission sought by HDFC Bank and HDFC Limited is clarity on valuation of certain assets that are held by HDFC Limited. Now, project financing loans that HDFC Limited has provided, there is more clarification needed with respect to certain procedural matters over there, and small investments in the book of HDFC Limited, how that will get accounted in the bank. So these are some of the key clarifications that HDFC Group is awaiting. Back to you.
Okay, thank you very much for that. So relaxation on the priority sector lending, but no relaxation on CRR or SLR requirements. But the stock of the day in the group is HDFC Life. It's now up close to about 4% in trade, but early in the morning, it was up nearly 7%. Surbhi is here standing by with the news on what's fueling the up move in HDFC Life. Surbhi.
Thanks for that. So RBI's decision to allow the merged entity HDFC and HDFC Bank to own over 50% stake in HDFC Life comes as a double booster. Now with this, HDFC Life will become a direct subsidiary of HDFC Bank. Now currently it has around 50% stake in the HDFC Bank channel, which is likely to improve from here on. Also, this will help to reduce their cost of distribution in the HDFC Bank channel, which will in turn help them increase their margins. Also, the possible overhang of a 19% stake sale by HDFC and HDFC Bank, if the RBI had directed to keep the stake below 30%, is now gone. Rather, it is now certain that the merged entity will acquire additional stake before the merger completion. Currently, Aberdeen holds 1.6% stake in the company and Exide Industries holds around 4% stake in the company. Just to alert, in September of 2022, Aberdeen had sold nearly 2% stake in the company. On the back of this news, brokerages have also upgraded HDFC Life. MK has upgraded the stock from an hold to a buy rating with a target price of 650, and Investec says that the stake sale overhang is now gone and HDFC Life remains a preferred pick for them among the life insurance players. They have a buy rating with a target price of 560.
Okay, got that. Surabhi, so that explains a little bit of excitement around HDFC Live today. But tell us, I believe there is a Morgan Stanley note, and they are sort of drawing out some takeaways for an ICICI group company, ICICI Lombard. What exactly is MS saying?
That's right. So Morgan Stanley has an interesting view on this. Now, initially, ICICI Bank had to bring down the stake in ICICI Lombard to 30% by September 2024. As of March 2023, they hold around 48% in the company. Now, Morgan Stanley says by allowing HDFC and HDFC Bank to increase their stake in HDFC Life over 50%, RBI has now set a precedent. On its Q4 earnings call, ICICI Bank did not specify if they would want to increase or decrease their stake in ICICI Lombard. But Morgan Stanley writes some implications for ICICI Lombard stock. Now, what are they? One, there is a possibility for ICICI Bank to increase their stake above 50%. Before, they had expected this to move below 30%. Now, increasing the stake would remove a big overhang from the ICICI Lombard stock, and they expect this to be in talking point in the market until ICICI Bank states which course will it take in the future.
All right, Surabhi, thanks a lot for getting us all of the details. So that is a complete roundup of what's going on with HDFC, HDFC Life, as well as ICICI Life. So that is everything that we're tracking right now. But with that, we do have to get into a short break. When we come back, we're going to focus on the commodity space. We'll bring you an update with Manisha Gupta. Welcome back. You're still tuned into Trading Hour. A lot of the pharma companies are under pressure today. I mean, we did see a little bit of a run-up last week, but right now you have Sun Pharma, which is the biggest loser right now on the Nifty. So it's seeing a 2% cut there. Cipla, DRL, some more, which are coming under pressure. Divi is also under pressure right now. But you know what's holding up? You have some of the two-wheeler makers which are doing very well today. So take a look at Hero Motorcorp. You have TVS Motors, which is doing well. Bajaj Auto also hit, Bajaj Auto did hit a 52-week high earlier this week as well. So that's what's happening as far as the two-wheelers go. But let's also talk about the commodity space now. We have Manisha joining us, and today she's going to tell us about the move that we've seen in crude prices. Hi, Manisha.
Thank you for that, Pavitra. And yes, with the kind of decline that we are working with, we're trading at a 5-week close for the crude oil prices. Last week was a 5% decline. And prior to that, in 4 weeks, the crude oil prices gained between 18 to 24% for the crude varieties there. Well, the decline comes in on the fact that we have seen strong PMI data come in from various economies. And that tells you that the interest rate hike could just about continue. And then the US also has added the oil and gas rigs for the first time in 4 weeks. Markets also are looking at or watching out for the first quarter GDP numbers that come in from US there. And then Russian exports also have continued to increase. Even with the output cuts that Russia has been talking about, the production and the exports are the highest since pre-COVID levels. And when you look at the numbers as well, these are on the higher side. And a statement from Russia does tell you that the revenue from the oil and gas exports in the year 2022 have been up by nearly 28%. So no dent really coming in from there. The US demand also has continued to decline, and we have seen that in the build-up that we've seen in US crude inventories, gasoline, distillate. All of those stocks have been rising, which is putting pressure on prices as of now. Okay, got that. Thanks, Manisha, very much for giving us an update on oil. So A little downbeat on that side of the market today. We will take a quick break on that note. On the other side, we talk technicals. Market's not moving anywhere. So can you look at individual stocks? What are the strategies like? Rahul Mohinder is going to be joining in. Welcome back. Here with us on Trading Hour, and the market continues to be absolutely locked in that tight range. Rahul Mohinder is with us on this leg of the show. Rahul, I'm wondering what you're trading. Is anybody trading the index at all these days? You tell us, how do you look at things as the week kicks off, and what are the ideas?
You're absolutely right. It's a bit of a tug of war, and I think there's a lot of frustration building up within index traders that, we haven't moved for a couple of days, and I think it's just a test of time. We've seen this many times in the past where the market struggles for a couple of days and then suddenly it comes, the breakout. But let's try and read the trend. I think first and foremost, we didn't break 17,550 over the last week, which I am clearly reading as a positive. That's a level I think a lot of people have in mind, clearly because of the kind of support the Nifty spot has demonstrated at those levels. Even from the Nifty Bank perspective, I think we're still in a strong bull grip when we look at most of the indicators. And if I had to compare indices, yes, the Nifty Bank is tilted slightly more positive than the Nifty. So keeping the overall trend as a positive in mind, I think one has to be stock selective in such a market. And, let me share some ideas. On the pressure side, on the sell side, I think something like an ITC, which hit that 410 level today, that could be, a stock which does demonstrate some weakness, in my opinion. 405 to 410, in my opinion, is a strong window of resistance for ITC. We probably could push back to about 395, 396 levels. So that could be on the sell side of things. But to balance it out, you've got some outperformers, which I can see in a stock like Titan, where I clearly see the stock will move to about 2670 levels. One could buy even at the current market at 20, with keeping a 2560 stop loss. Another stock which has corrected quite rapidly in the near term is Maruti. And, it's come to that 8450 to 8500 belt, which I'm identifying as good support. One could use this as an opportunity to get into Maruti, keeping a clear stop loss below the 8450 mark. I think, again, a trot back up to about 8630, 8650 is fairly likely. Now, another stock, if I could add, within the auto space is Tata Motors. Here, too, we've seen a very resilient performance over the last couple of weeks, despite a tepid index. But, Tata Motors has stood out, and I still think is good for more. Probably, if you're short-term, 482 could be a near-term target. I'd buy with a 463 stop loss.
Okay. Thank you very much, Rahul, for joining in. Let's talk about some other movers, and this time on the way down, it's Sun Pharma. That's the top Nifty loser. The company has received a letter from the US FDA for its Mohali facility. The company is now, Ekta is now joining in with the details. Ekta?
Thanks for that. Well, yes, definitely negative news which has come in for Sun Pharma because they have received a letter from the US drug regulator for their Mohali facility, which is located in Punjab. Now, the letter is titled basically a consent decree correspondence. A consent decree was basically provisions to apply to or adhere to compliance which they had entered in 2013 when they were a part of Ranbaxy. And this basically is a non-compliance letter and a part of the consent decree which they had received or were a part of a couple of years ago. Now, the US FDA for this particular communication which has taken place is probably linked to the fact that they had inspected the Mohali plant in August of last year. At that point in time, they were issued 6 observations. And at that point, the street had brought up concerns that maybe there could be a linkage to data integrity in these observations. Hence, the street was expecting an escalation. Now, in terms of the current developments, the company is going to be taking certain corrective actions before releasing final product batches into the US. Actions include retaining an independent expert to conduct batch certifications. The company has said that this is basically a temporary pause in terms of release of batches from the Mohali facility. The likes of Incred have said they expect a low mid-single digit impact on numbers from a 3 to 6 month time perspective. Now, the larger impact of this particular development is also that the second plant of Sun Pharma is now under the US FDA scanner just in the span of a couple of months. In December of last year, they had their Halol facility, which is one of their largest facilities supplying to the US, which was issued an import alert. Before that, previously, the Halol plant was issued a warning letter in 2015, which was eventually resolved in 2018. So this is making the street question the company-wide regulatory compliance because of the developments which have taken place on Halol as well as Mohali just in the span of a couple of months. However, the markets are bullish on the company's specialty business and the fact that they would be launching key drugs in the US. Hence, that is possibly going to cushion some of the fall. Nomura has a buy target price of 1190. According to them, the development is a negative surprise. It is US FDA's step to ensure further scrutiny of batches, signals an escalation of the matter. JP Morgan has an overweight rating and a target price of 1200. They see limited financial impact on account of these developments, given it's a temporary pause.
All right, Ekta, thanks a lot for getting us all of the details on Sun Pharma. It is the top loser on the Nifty this morning and it is around 2% in the red. But one stock which is holding up well is Ami Organics. This after it announced its semiconductor foray. So it has acquired majority stake in specialty chemicals maker Baba Fine Chemicals. So Sonal is here to tell us more about that. Sonal.
Thank you so much for that. Well, it's an interesting foray that the company has actually entered into. They will be catering to the semiconductor industry. It is via an acquisition of a company that provides chemicals to the semiconductor industry. That's the kind of exposure they'll have now. They've acquired 55% stake in Baba Fine Chemicals, which is a custom specialty chemicals manufacturer for semiconductor industry. Here, the consideration for this stake is 68 crore rupees, subject to adjustments that may be required at the closing stage of this particular transaction. The combination of this consideration is cash and also issuance of securities of the company to existing parties. This is on a preferential basis. Valuation, according to the company, is 4 times adjusted EBITDA for FY23 of the company which is being acquired, and deal is expected to be completed in 6 months. If we just go through the revenues as well, for Baba Fine Chemicals, they have been increasing from levels of 26 crore rupees in FY21. Company has been able to do revenues of 47 crore rupees in FY23. That's basically doubling in last 3 years. And it is, of course, a positive update because this industry is it has high entry barriers. So this acquisition gives them that entry into an industry which is little difficult to tap, and they will get a good partner here as well, which already has the technology and know-how to make chemicals for the semiconductor industry. Analysts say this acquisition will be EPS accretive and will help in ramping up volumes for the company. So all in all, it's a good takeaway for the company.
Thank you very much for that. We'll slip into a break. On the other side, we'll focus on the earnings reported by ICICI Bank and Yes Bank and the earnings expected from Indices.
Welcome back. Well, one stock that continues to be in focus is ICICI Bank. In this dull market, it is managing to hold up around 1.5%. And what a blowout quarter it has been for the bank. You're talking a 40% growth in net interest income, 30% growth in profits, and margins almost touching 5%. Let's get to Abhishek Kothari to understand what's powered this kind of a move. Abhishek, dream quarter for ICICI Bank, right?
Well, it's been a robust quarter for ICICI Bank, and Sandeep Bakshi has created a history for ICICI Bank in terms of its Q4 FY23 performance. So if you take a look, the net interest margin is at all-time high. Domestic net interest margin has crossed the 5% level, and international net interest margin is at 26-quarter high. You take a look at the NII growth of more than 40% on a YY basis is perhaps the best that you are seeing in last 8 to 9 quarters, or even 8 to 9 years, or even 10 years. Highest ever quality return ratios. You are seeing ROA of 2.39% and ROE of about 18.9%. Asset quality, one of the best in last 8 years or even more. Gross NPA ratio has come down to 2.81% and net NPA ratio is down to about 0.48%. You are seeing this net interest margin movement being largely aided by the fact that unsecured portion of the loans are at 22-quarter high in terms of the percentage of loans. So that is now now at 19.4%. On the flip side, the deposit growth on a YY basis is below 11%. Now that needs to catch up with the loan growth going ahead. So going ahead, as management has indicated, there could be pressure on the net interest margin from the current levels. PNL, NI and PAT is a beat on our poll. What brokerages are saying that ROE will increase to about 17 to 19% over the next couple of years. They have raised estimates anywhere between 3% to 9%, and they see uptick in deposit mobilization as a plus, and they expect that to continue in FY24 as loan growth actually accelerates. So across brokerages, you are seeing positive recommendation with a target price ranging from as low as 1100 per share to as high as 1200 per share. Back to you.
Indeed, thank you very much for that. ICICI Bank stock price is below 900, almost at 900, 896. But look at the target price. Morgan Stanley pegs the target price at 1250. CLSA is at 1200. Jefferies is at 1180. So brokerages very, very bullish on the prospects for ICICI Bank. But let's also listen in to what... Okay, we'll get to that in just a moment. We'll find out.
We'll look at, Rima, let's actually, before we move ahead, let's look at Sandeep Bakshi's bites, because he gave some commentary on the business trajectory going ahead.
Including non-fund based outstanding, the retail portfolio was 45.7% of the total portfolio. The business banking portfolio grew by 34.9% year-on-year and 7.8% sequentially. The SME portfolio grew by 19.2% year-on-year and 6.2% sequentially. The growth in SME and business banking portfolios was driven by leveraging our branch network and digital offerings such as InstaBiz and Merchant Stack. The domestic loan portfolio grew by 20.5% year-on-year and 5% sequentially. The overall loan portfolio grew by 18.7% year-on-year and 4.7% sequentially. Looking ahead, we see many opportunities to drive growth in the risk-calibrated core operating profits. We believe our focus on Customer 360, extensive franchise and synergy and collaboration within the organization, backed by our digital offerings and process improvement and service delivery initiatives, will enable us to deliver customized solutions to customers in a seamless manner and grow market share across key segments. We will continue to make investments in technology, people, distribution, and building our brand.
That's ICICI Bank for you. Let's talk about Yes Bank. The stock is down 3.5% in trade. Prima facie, it looks like a mixed set of numbers. On one hand, the gross NPA or the asset quality has deteriorated, but on the flip side, the company's net interest margin is the best in the last 9 quarters. But as I said, the stock is weak in trade. Earlier today, we had a chat with Prashant Kumar, the MD and CEO of Yes Bank, on the quarter gone by and the outlook going ahead. Listen in.
In the FY24, the slippages would be somewhere between 1 to 1.5%. Retail is growing much faster than the corporate. So even the last year growth has been 38%. I think this trajectory would continue for some time, and retail would be somewhere around 50% of our balance sheet. Regarding the NIMs, I think we are still in that trajectory where for us this is not peaking out. This would be a continuous upward journey for us.
Right, that is the word from the Yes Bank management, but the focus will continue to be on banks this week. We have many large ones, Indices Bank today, we also have Kotak and Axis later in the week. But Abhishek is back with us to tell us how Indices numbers could really look this time around. Abhishek, what's expected?
So Indices Bank is expected to have a strong quarter this time around with highest ever quarterly PAT. They have already given the business update in which the deposit momentum is pretty strong at 14.6% YOY and about 3.4% quarter on quarter. The loan growth coming in at 21.3% YOY is perhaps the best in last 15 quarters, and sequential loan growth of 6.6% is perhaps the best in last 16 quarters. However, on the flip side, their CASA ratio is at 9-quarter low, coming in at 40.1%, and calculation shows that CASA has declined in absolute value by 1.3%. So retail deposit, that momentum continues to remain healthy at 15.2% YOY and about 3.7% quarter on quarter. And CD ratio is at 9-quarter high in terms of coming in at 86.2% when compared to 83.6% in the previous quarter. So you can expect the net interest margin to improve YOY as well as quarter on quarter. Phillip Capital estimates 10-quarter low slippage of about 1,400 crores So asset quality is expected to improve on a sequential basis. Previous quarter, the gross NPA ratio was at 2.06%. Commentary in terms of business growth going ahead will be an important factor to watch out. So our poll suggests NII growth of 18.3% YOY and about 5% sequentially, while PAT is expected to grow at 47.8% YOY and about 2.5% quarter on quarter. Back to you.
Thank you, Abhishek, for that. Let's move on now from banks to chemicals. This is our quarter se quarter tak segment, where Sonal brings us up to speed with the expectations from the chemical space. Sonal.
Thank you so much for that. Well, every chemical company has a different fundamental and factors affecting individual performance as well. But if I talk about the overall chemical industry, it is largely expected to have an improvement on a quarter-on-quarter basis. This is due to pickup that we'll see in exports. But there could be a muted performance YOY in some cases due to a weak global demand environment. Now let's talk about raw material costs. Basic chemicals, they have seen a decline in pricing, and that is because crude prices fell 8% on a sequential basis. Feedstock for oleochemicals, that was down 20% on a sequential basis. And ocean freight rates, they are down anywhere between 40 to 50%. So this will, of course, aid margins quarter on quarter. But demand pressure will continue in discretionary sectors like dyes and pigments, polymers, something companies that they have been telling us. Now, the fluorochemical space particularly. Sustained high price in refrigerant gases will aid earnings. However, there will be weakness in packaging and technical textiles business. This is just for SRF, and that's why revenue will be flat. EBITDA and profits for the company will be down this time. However, for Navin Fluorine, earnings will be aided by high-performance products in specialty chemical segment, leading to a 56% revenue, 98% EBITDA, and 52% growth in profit after tax. For Aarti Industries, which recently saw demerger of the pharma business, we will not be able to compare numbers YOY due to the demerger. But incremental revenue will come in only from new capex after FY24. And that's why revenue is flat in quarter 4. EBITDA is up, but the profits are expected to be down by 2%. For oleochemicals player, Galaxy Surfactants, it will be a steady performance after some weakness that we saw in last couple of quarters. Volumes are expected to grow 6%. Performance surfactants will be up 10%, but specialty, which is the higher margin business, will see flat performance. For Jubilant and Grevia, operational metrics will be weak, down anywhere between 11 to 15%. This is, of course, in a high base. Acetic acid, which is the raw material, has seen a 40% decline in pricing, which will lead to lower revenues for the company as well. Generally, active ingredients have seen a decline, and that's why performance will be weak. Now, taking you through the stock moves this year and valuations, barring few, these stocks have underperformed. SRF, Navin Fluorine, they are up anywhere between 8 to 16%. However, valuations for Navin Fluorine are at an industry high at 45 times. Galaxy Surfactants is up with valuations at 23 times. Aarti Industries is also on the lower side. It's around down 10%, but valuations at 33 times. As far as the new listings are concerned, Tattvachintan, Clean Science, Chemplast, all of them are down anywhere between 7 to 23%, with valuations very low for Chemplast at 13.5 times, and for Clean Science, 40 times after listing at around 80 times. So big fall is what we've seen there.
Okay, thank you very much. Very interesting there, Sonal. So many small companies, different companies, but the dynamics are different for each of them. Thank you for taking us through that. Get into a break. On the other side, we'll discuss markets, the way forward. Ashutosh Bhargav from Nippon India Mutual Fund joins in next.
Welcome back. As flat can be on the indices, but we'll take the conversation forward. Ashutosh Bhargava, Fund Manager and Head of Equity Research at Nippon India Mutual Fund, is with us. Ashutosh, good morning, and thank you very much for being with us on the show. So we're all trying to sort of look for direction. I think the market's trying to make sense of things, and earnings are the real litmus test, right? We were looking at some of your earlier holdings. This is, of course, as of 2-3 months ago. Tell us if this has changed. But you seem to have a lot of large cap financials, particularly large cap banks in your portfolio. There's Axis, there's HDFC, there's ICICI. And if ICICI's numbers are anything to go by, this seems to be at least one pocket of the market that's rock steady and firing away. Your thoughts on financials, whether you've done any changes to your holdings, valuations, and whether you can still put more incremental money, fresh money to work in the same stocks?
Thanks, Ruby. So yes, financials, we have been overweight, particularly on large banks. The reason is twofold. One is the valuations. I think valuation, despite the run-up in banking index, they remain cheaper versus their stocks' own history. They particularly remain cheaper versus the rest of the market and other large sectors like IT, etc. We have seen a massive amount of upgrades in FY24, throughout FY24, in banks earning. And we think at this point of time, the credit quality, whatever estimates we have on credit growth, and more importantly, the elevated margins that we are seeing, makes us believe that the 13-14% earnings growth, which is expected over the next 2 years, that estimates will easily be met from financial side. So both from the valuation perspective and more so from the earning resilience perspective, we think this is one sector which could continue to take market relatively higher.
Follow up, Ashutosh, on that. You mentioned margins. A part of the market, at least a section of the street, feels that we've seen the best in terms of margins and now it only comes down from here. Could that lead to some profit taking? Is that a concern you have?
So there's no doubt that margin relating has been very sharp, but we don't think that margins are going to come down materially. Yes, we might be near the peak margin, which some of the banks have also highlighted. But we think there are some levers which can keep margin at these elevated levels. And within banks, I think from the public sector bank side, there is still potential for margins to further go up because there is a significant section of assets which are still fixed cost in nature, and there is a potential for upward repricing of those assets in next 1 to 2 quarters. So there you could even see margin expansion. For the large private bank side, yes, you could be right that we are very near to the margin peak. But as I said, the hurdle rate is very low from banks' profitability expectations are concerned. 13-14% expectation for the next 2 years. I think that can easily be met.
Ashutosh, morning. Rima here. As a house, what is the call on investing in large caps, mid caps, or small caps? Because small caps have gone through a very long period of underperformance. I think in the last 5 years, the return has been negligible, practically flat. The markets at the same level as what they were in January of 2018, thereabout. So given the kind of underperformance, the time correction that we've seen, and the fact that valuations are also fairly reasonable in small caps, would you recommend a higher allocation in your SIPs to small caps versus the large caps? What's the house call here?
As a house, we believe that there are opportunity in all the three size category, large cap, mid cap, and small cap, and we are not particularly tilting over one over the other. What we think, the better approach would be to look at sectors where this year there could be some bit of top line recovery, because that won't be there in a lot of sectors. But there is a reasonable amount of margin recovery, which I think could be there in a lot of sectors in FY24. And try to find bottom-up ideas across three market sizes. Purely from valuation perspective, when we look at small and mid-cap valuation discount to large cap, that doesn't give us a lot of comfort to squarely and overly go over, overweight on mid and small cap over large cap. But the point is well taken that over the last 18 odd months, the broader market or the side market, there the overall time correction and valuation correction has been more pronounced. But it's very difficult to be overweight on one over the other.
Okay, so you're not really recommending a move away from large caps to small and mid caps. And you did say that you will have to look at specific sectors to find opportunities, or even specific stocks. You want to take us through some sectors. I know you like the financials, like you mentioned, but anything else where you think overall that sector is likely to do well, even in a very range-bound kind of market?
In fact, both local and global nominal growth would be under pressure over the next few quarters. What will drive earnings and perhaps the stock returns would be margin. And I think there are sectors where you could see a meaningful margin recovery, along with some bit of top-line support. Sectors like autos, pharma, utilities. So other than financial, these are the sectors where there is a potential for us to increase weights and be more constructive. Staples is another sector where we could see some margin upgrades and marginal, growth in terms of top line. But as I said, some of these domestic-oriented sectors like domestic autos, utilities, banks. These are the ones we have maximum confidence as far as earning resilience is concerned.
And you mentioned that you could look at increasing weights in auto and also auto ancillary, or are you looking at only autos for now?
So domestic-oriented companies is where we think there is more demand resilience, and domestic OEMs across the board is where we think there could be, upgrade possibility, or earnings would be much better than the rest of the market. So this is where we would focus more on rather than, ancillaries, where we already have exposure and they have some exposure in terms of global growth, which to our mind could be in the near term would be a challenge.
So by that logic, would you lower your weightage or downgrade technology?
So the thing with tech is that, if you just compare with, say, financial, there the valuation premium at which tech was trading, it has narrowed, but still remain at a premium versus the long-term history. So typically, IT index has traded on a one-year forward basis around 8 to 10% valuation premium, say, versus bank index. Today is still around 15% higher valuation premium. So we think that purely from valuation perspective, IT is not that attractive. And when we think from short to medium term earning potential, earning upgrade potential, I think banks are stand out, and we perhaps could see 1 or 2 more quarters of IT earnings to bottom out. So in that sense, we have remained underweight on IT versus financial, and I think that stance would continue for another 1 to 2 quarters. And then we reassess at that point of time for potential risk reward in the subsequent quarters.
All right, so not yet for IT names. Ashutosh, thanks as always for joining us and taking us through your call. That is Ashutosh Bhargava telling us that the sectors he still likes are the financials, some of the autos, and also stable names within the Indian market. But with that, it is time for a short break on the show. When we come back, we are going to talk about how the incremental business momentum has looked like in FY23 for the banking sector. It has been the best ever. We're going to bring you all of the details when we come back. Welcome back. Now on to our special segment, Fin Street. Abhishek is standing by the big wall with all of the details on the FY23 business momentum for the banking sector. Abhishek, take it away.
Well, incremental business momentum for the banking sector in FY23 has been the best ever, with incremental deposit momentum of 15.8 lakh crore and incremental loan growth of about 17.8 lakh crore. Hence, the incremental credit deposit ratio, or the CD ratio, for the banking sector was at 113%, which is the highest in last 15 years. In a rising interest rate scenario, an increase in CD ratio augurs well for lenders, given the fact that it will help the net interest margin remain on the healthier side or not fall sharply. However, one can expect the net interest margin of lenders to decline from Q1 FY24 results onwards. This will be due to the fact that the rise in cost of funds for lenders will start kicking in, as maximum hike on the lending side is already done or has taken place. Banking sector has ended FY23 with total deposits of 180.44 lakh crore and total loans of about 136.75 lakh crore. The credit deposit ratio for the sector for FY23 is the best in last 3 years, coming in at 75.8% when compared to 72.2% in the previous year. Now, deposit data shows that on an incremental basis, the growth in demand deposit is the lowest or slowest in last 3 years, while the incremental term deposit growth in a fiscal is perhaps the best ever that you have seen. Also, kindly note that some of the low-cost deposits may have moved to high-cost term deposit due to rise in interest rates that we saw in FY23. Now, sectoral data as of Feb 2023 shows that personal loan has been the big driver of loan growth in FY23. So as of Feb 2023, incremental loan growth has been about 15.6 lakh crore. A breakup shows that incremental loan growth has been driven by personal loans, which formed about 40.2% of the incremental loan growth. Services formed about 32.5%. Agriculture about 12.5%. Industry close to 9%, while food credit actually saw a decline nearly by 19,700 crores or about 1.3% year to date in Feb 2023 so far. Now, the loan breakup for the industry as of Feb 23 shows that personal loans formed about 29.8% of the loans, services formed about 26.2%, agriculture nearly about 24.5%, industry about 12.3%, food credit nearly 7%, and others about 0.26%. So in terms of outlook, the loan growth may slow down going ahead. Higher repayments of principal amount in the EMI can also lead to slowdown in the loan growth rate. Inflation, that can also hurt the loan growth for the banking sector in coming quarters. However, the key to watch will be the deposit momentum. The war has already started on deposit rates, especially by HDFC Bank, which is offering one of the highest term deposit rates amongst large peers. Now, private banks have gone back to branch expansion in order to grow their balance sheet. PSU banks, many have seen their balance sheet grow due to the foreign book as well. So with slowdown in global economy, we will need to watch out for the performance of overseas book for some of these PSU banks.
Abhishek, busy day for you. Thank you very much for joining in with that. Out of time on Trading Hour from the entire team. Thank you for watching.